Today is April the 18th. This is the Budget and Finance Committee for the Recreation Centers of Sun City West. My name is Dick Rhodes. I'm the chairman of the committee. And at 9:01, we're going to convene the meeting. I'm going to call it to order. So if you would all please stand and pledge allegiance for this. We do not have a large agenda today, and we fully do not expect to have another 2-hour and 43-minute meeting. So just for those of you who want to know that, please make note. We have established a quorum. All of our members are here. We do have an amendment on the minutes from April the 4th. It will be paragraph 3.03. There's an insertion on the second paragraph. A request was made to reject all requests for new capital spend, and a second request was made to remove and replace the pool deck project at the R.H. Johnson pool. The committee consensus was 6-1 to leave both in the budget. Okay? So do we have any discussion on that? And if not, we'll consider it accepted. The only new item on the agenda this morning is to have a presentation on our property and casualty insurance. That review will be conducted by representatives from the agency of Brown & Brown. Cliff, would you like to introduce them, please?
Thank you, Director Rhodes. Good morning, everyone. So today we have Ren Linville and John Newhouse here from Brown & Brown. They handle our property casualty insurance. And Ren has been with Brown & Brown as an account executive with Brown & Brown since June of 22. His service has he's serviced a variety of large commercial accounts. He was with the Farm Credit Council Services from 2016 to 21 as a senior risk analyst, and he acted as the central risk manager for the group of banks that provides loans to farmers as a government service entity. And then with Lockton Companies from 2014 to 2016 as an account administrator. John Newhouse has been with Brown & Brown since 1994. And he is the president of the Minnesota office and experienced risk management and insurance professional servicing a variety of commercial accounts. John was one of the 6 founders of the Hayes Companies and was part of growing the company from growing the company to 800 employees when in 2019 they sold the company to Brown & Brown. John has focused his career on working with clients in all industries and sizes. So join me in welcoming John and Ren from Brown & Brown.
Can I come up there? Yeah. Thank you. Well, we put together a short presentation here. I'm as much interested in the specific questions either the board has or the audience members have. So thank you very much for your continued trust and confidence in allowing us to handle your property and casualty insurance placements. We take the spend that you guys have on these lines of insurance very seriously. We recognize the importance of every dollar. We try to couple that with a combination of risk management ideas, take more risk, buy more insurance, less insurance, things like that. So we try to come up with a holistic picture, working with members of your finance group to come up with the best program for you guys. At the end of the day, the insurance is up to you guys on how much you choose to buy, and it's our job to help make sure we get it procured at the most cost-competitive price possible. When we think of risk management insurance, We look at the corporate buying of insurance as a business relationship similar to your accounting relationship or legal relationship that you guys would enter into. We try to see ourselves as consultants with you guys. This year, we worked very closely with your existing insurance companies. For the second year in a row, they've been on your account. We worked very closely with them to make sure that they were offering optimized coverages as well as the best pricing. 2 years ago, we had taken your account out to the insurance marketplace, presented it to about 10 different insurance companies to compare the pricing. And the existing insurance company won out, and they've had your relationship for a number of years. Okay? So, so I guess I would say there's a number of people within our organization that are part of working on your account. Myself as kind of the lead person working in conjunction with Ren. But there's a number of subject matter experts that also you guys have access to, and at various points in time in our relationship, you would interact with those. For instance, there's a need for us to have a technical expertise when we place your cyber insurance. It's a very technical coverage, and so we have a number of experts that are very focused exclusively on placing cyber insurance. Our team has 12 people that focus exclusively on cyber. Executive risk, so that's your D&O, EPLI, crime, fiduciary coverages. Those 4 coverages, again, I've got, I think, 13 people in that department that focus exclusively on placing those coverages. Again, those are very unique and technical, and we want to have experts that are practicing in that line of coverage on a daily basis. Risk control or safety, these are the people that are going to be helping to make sure we identify areas where the property isn't safe. It could be looking at ergonomic issues. It could be looking at how you guys store piping. It could be looking at your properties. It could be looking at the sprinklers. You know, if you were to do new construction, those types of things. The second area that group would focus on to help provide you guys consultation would be the insurance company may come and say, you guys need to do these 3 activities, and we may not think that that's cost effective or practical or necessary, and so we want to have experts that can counteract some of those recommendations. Now, we always take the recommendations from the carrier seriously, and we learn from those, but if there's an opportunity for us to find a better solution than what they're offering, those people would work with that. Claims management, we have 5 attorneys on staff in our claims department and 7 other professionals that are working with our clients in the event that they do have a claim. Those people's job is to advocate on your behalf to make sure that the claims, when we get them turned into the insurance company, that the insurance company is going to handle those claims the most effective way possible and get the maximum amount of coverage for you guys. Stewart is one of the attorneys in that department. Analytics is the last department shown up here. Those people would be working with the claims data, trying to identify trends within the claims data that we would push back with the analytics or with the risk control group if there's negative trends that we're seeing. So that's kind of a list of the various people. Ren and I place the remaining lines of coverage, the liability coverages and property. So as we look at your renewal year over year, the insurance company focuses on a couple of baseline lines of coverage or baseline pieces of information as they look at how they price your coverages. One baseline piece of information they look at is your properties. You've got multiple properties on site, and they look at the various properties, and the important variable that they're looking at there first and foremost is the construction, and they have real good information on the construction of your property, if there's sprinklers, what kind of water flow coming into the property, is there cooking stuff there. They look at all of that stuff and they take it very seriously. The second key variable that they look at is the total value of the properties that they have. Think of your home. year over year, your home was $100,000 one year, the next year it probably increased to $105,000. Why is that relevant? The insurance company, if this whole property were to burn to the ground, the way the policy is written is that they would replace it with like kind and quality. Okay, and so I think everybody has read that there's inflation out there. And so the insurance company, as they looked at your properties, the cost of construction to put up the same types of walls, the same types of chairs inside, they increased the value by 7% this year. Okay. Some other benchmarks that one could look at would be, there's some other industry standards that would say the inflation index for construction should be 12 to 19%, depending on which guideline you're looking at, okay? And so there was negotiation on our part to make sure that we didn't get the higher end of that inflation index charged to you, because you're going to get charged more as the value of your property goes up. Now, what we have done with your property is we've created a blanket limit. So this building might right here be worth $2 million, and the one over there might be worth $5 million. Combined, it's $7 million. Totally, you guys have $56 million total. We put it on a blanket. And so if I reported this building as $2 million of insured value, and it was to burn to the ground and it actually cost $2.5 million to insure, we would still get $2.5 million for it, okay? So that's one key thing that they look at. Another variable that they look at is there's various parts of this operation that are generating revenue, and so they look at the revenue that's taking place. The square footage year over year has stayed the same, obviously, and so they would also be looking at that. Any questions on that?
We'll hold our questions until you're done, because.
No, I'd rather take them in between, just so you know, so we get them
Okay,
addressed.
I do have questions,
Mhm.
okay? And I'll ask the committee. You had said that that you had gone out and you presented our case, or whatever you call us, a client,
Mhm.
to multiple insurance companies, and the one that we had won out. And I have to openly admit that I am not an expert in insurance requirements, but the question that jumps out at me is, when you say our insurance company, but I've counted in here 10, 12, 15 different companies that are here. Are they subsidiaries of that, or are they just partners, or how does that work? I don't understand that.
Yep. Thank you for the question. There's actually multiple insurance companies that are on your account, and they are not subsidiaries of each other. They're separate companies. And so I negotiated with all of those, but each of those focuses on that specific area. Does that make sense?
Well, I do, but so when you say an existing insurance company won out, that means that you would say that 10 or 12 different times. Because
Exactly.
that's
Yes.
how many. Okay, another question. You have an analytics department. And you did a very thorough job of describing that, I might add. This particularly interested me because they talk about developing trends in claims.
Mhm.
Did you do one for us?
We did as part of the stewardship meeting, yes.
Okay, will that be presented to us?
We can get that for you, yes.
I think that would be very important. I think that's a very
Yep.
critical. I can't speak for the committee. I'm going to actually let them ask questions, but that's one of the things that I see here that's more information that I would want to see. I want to see what happened. How does this affect me? How does this affect us? How does this affect our homeowners in Sun City West? Because what I see here is a very global description of what's happening in the insurance industry. And this, by giving us the analysis, may help satisfy our knowledge.
Sure. There's I know in the back of the document, there's a high-level summary that we did of your claim information, but here is, 28 pages of claim information, or give or take, whatever, that exists on the various claims. I would opine that there's nothing on here that is that great. And so that's a good thing for you guys, right? We don't want you to have claims. We want to have the insurance available for when you have a really bad accident, right? But yes, you have had claims. There's been a few bad ones, and then there's other miscellaneous ones. And then because the way you guys purchase insurance, for instance, on the property, there's a $5,000 deductible. And think of that similar to your homeowner's policy. There's a lot of things that would happen to your homeowners. Maybe you have a $1,000 deductible there, and you would not report all of those matters below $1,000. And you may not even report one that's $1,500 to me, right? But the insurance would be there available for you guys in the event that you were to have a claim.
Does anyone in the committee have a question? Susan?
I think I have two questions. First, it's with the blanket building limit increase. You mentioned gross sales. This is a new concept to me, that sales are affected by the building coverage.
They're
It's-
unrelated.
Okay.
They're parts of two different rating structures, Susan. The property insurance, so the property insurance right here, that's the $56 million that they would rate that on. The general liability on the far left-hand side of the screen there, they would use the gross receipts as part of the rating structure. In addition to a few other variables, square footage might be one. The umbrella, the excess, and the second excess, those policies would use the gross receipts in addition to. The umbrella also uses the total number of vehicles that you guys would have as well to rate it. And that's very simply said. There's more than just those variables that go into rating it. You know, if you think of your homeowner's policy, they would look at where you're located, how close is a fire department, your auto insurance, they would look at, do you have, driving tickets, that type of thing. They would look at, for you guys, all of those same variables. They would look at the safety protocols that you guys as a business have implemented to make sure you operate a safe environment.
Okay. I'm not quite 100% on this.
Okay, I'm sorry.
Maybe I'm being a little dense. I guess I'm thinking of gross sales and having insurance coverage for business loss. Am I mixing these two things up here?
So there's two different, so property insurance is the building burning down.
Yes,
Liability insurance is you hurt somebody,
Yeah.
third-party bodily injury or property damage. And
Sure.
so the liability policy would use, they have to come up with some variable for the amount of exposure that you guys have here. How many people are on the golf course? How many
I
people?
understand all of that. Okay, I understand all of that. It's just the gross, the loss of revenue.
It's not loss of revenue, it's the sales. You generated
Okay.
at the golf course $100,000. And so if you generated $50,000 in revenue at the golf course, they would feel that you got half the amount of exposure at the golf course.
Okay, okay. I get
Half
it
the
now.
amount of opportunity for risk.
Gotcha. Okay, thank you.
Mr. Bosak?
Thank you very much. Do you have a local presence, or is everybody Minneapolis?
Nope, we do have there's about 55 people here in Phoenix area, yes.
Okay. And one of the intriguing things you mentioned was your apparent involvement in new construction.
Pardon?
You have a group of people that are involved in helping us through the
Yep.
thought process in new construction. Carl, do we use any of those people for that type of activity? Oh, is there something we're missing there?
They're available if you want us to review plans in conjunction with the insurance company to make sure we're continuing to build to a similar standard that you have. Yes, we're more than willing to do that.
As a consultant, so that would be part of what we're paying you for ahead of time. There's no charge
Yes.
for that. Okay.
Yes.
And the 7% valuation of our properties, is that part of what factors the total value that impacts our reserve fund?
Yes and no. They're not
You
tied
look like a
together.
Cheshire cat.
They're not tied together, but we certainly, when we
Well, that's one element to consider.
yeah, part
Okay.
of the renewal process is that we provide that data to them, and obviously it's because we have umbrella coverage and blanket coverage over everything and an aggregate coverage. It's not dollar for dollar, but yes, we do consider that.
Thank you.
Dr. Miller?
Thank you. Your risk control folks, how often do they visit us, and how much time do they actually spend here when they do visit?
So there's two levels of that would take place. One is our people would come here, and secondly is the insurance company would send people here. When our people would come here, they would spend anywhere from 8 to 16 hours probably, walking the property, talking to various departments. If you direct us to a certain area, the insurance company may come out here and they would focus potentially on a specific area year over year.
Okay, so do your people show up every year, or just when we ask them to, or how does that work?
I do not, I'd have to go back to check to see when one of them has been here, whether they came last year or not. I don't know.
Okay, and the insurance carriers themselves,
Yep.
they don't come on a regular basis, or do you ask them to come, or do they make that decision independently of you?
Combination of both. We may ask them based upon looking at analytics that we're concerned about something through the claims data. They may say they want to come and look at something because they're seeing trends in another similar related risk, and or they may see information in the data as they look at all of the information they have that they're concerned about, and they would come out here and look at it.
Okay, all right, thank you.
Dr. Brown?
So do you say you come out and you look at, you review us, and the insurance companies do you all share data?
I share with them what I choose to share with them.
Okay.
If
Can
I
you
see
explain
something
that
I don't
further?
like that I think they're going to be concerned about, I don't mean to be flippant, but if my job is to be your advocate, and
Okay,
if there's something here that I'm concerned about, I would work with your internal staff to fix it before I tell the insurance company about it.
okay, well, I would expect that, yes.
Mhm.
Okay, thank you.
Thank you.
Mr. Hubald?
Thank you, Mr. Chairman. My first question is for Cliff, I think. And you'll have to bear with me. I might need some help with my questions, for that matter. Cliff, the $56 million, how does that compare to our fully funded balance records?
When we talk fully funded balance, we're talking about the used portion of the cost of the assets. So it's about in line with that.
Okay,
Yes.
that's what approximate is good enough on that.
Yeah.
Second, John, as I look at this, the chart, the coverage stack chart, it looks to me like our insurance premiums are about $65,000 a year for the basic. The colored chart there, the excess liability and at the top there, and then there's a number of umbrella policies, and the number of umbrella policies is about $400,000. As I've just quickly went across and added up the premiums, and this is a test. I want you to give me a grade on this. Am I understanding this chart that we're paying about $465,000 in this fiscal year? You know, I'm trying to get out of the presentation. I'm trying to pull how much are we paying?
$591,000
$591,000.
for all the coverages, yes.
Okay, $591,000. How does that compare to like the previous year? And,
$555,000 last year.
okay, so an increase of
7 or 8%.
7 or 8%. Yeah,
And,
okay. I'm trying to tick and tie some of these numbers
yep,
and look, stepping back from some of the detail.
yep.
So we got a number there, and we got approximate increase there. Can you give us any, or give me any insights into the selection of the limits of the coverage?
Yeah.
Does that come from you, Brown and Brown? Does it come from our administrative staff here? You don't need to write a book on it, but give us at least an overview of how are these determined?
Yep. Thank you for the question, John. So yes, your premium went from, 550,000 to 590. Keep in mind, the reason, sales were up 12%, that's going to drive up the premium, and your property values were up 7%. Okay, so that also drives the premium up. That's important to understand it. Think of it like this. If you had a car, 5-year-old car, and then you bought a new one, same brand, my gut reaction is the new car would be more expensive to insure than the older one. Okay, and so you're going to have to pay a little bit more as the business grows a little bit, okay? Regarding the amount of limit that you purchase, that is always a question that all my customers ask. How much should we buy, and do we buy too much or too little? And at the end of the day, we'll give you guys different benchmarking concepts and ideas of how much people buy, but at the end of the day, you as a business need to decide how much do you guys want to buy, okay? Now, I looked at our client base across all of Brown and Brown. We do hundreds of customers that would be similar profiles. Maybe they're not as big as you, maybe they're bigger, but that I would say are similar types of operations as Sun City here. The average limit that those customers buy is just under $5 million. Okay, you guys buy 25. And so you may say, should I buy less limit? And at the end of the day, it's you as a business have to decide whether you want to buy less or not. Because what can happen, of course, is there could be a bad claim, and they would sue you. They could collect the assets of the insurance policy, right? $25 million. And if they were hurt and aggrieved enough, they could choose to sue the entity and collect the assets of the entity. And so the question is, as we look at the coverage, you don't buy an unlimited amount of coverage, but as we look at the coverage, for you to buy the $26 million of coverage, it would cost you another $1,500. And so the question you as a business and a board should think about is, how much do I want to keep spending for insurance? Another $1,500, I can get you another $1 million. You may say, okay, what is the type of exposure that we as an entity could end up with? And I would suggest that as I think of your business, there's a couple of main exposures that could be pretty substantial. One could be an auto accident. I'm sure many of us have read in the newspaper large claim settlements. Anytime there's a bad truck that's involved in an accident, there's always lawsuits that come with it. And so when corporations have vehicles, that seems to be a huge exposure for my customers. And so they take that pretty serious that they could get sued for a very large claim. The second type of exposure that I could see you guys having could be something on the premises that could involve a member or a guest getting hurt, bodily injury. Now, I'm not as convinced that that could be as great as an auto accident, but that to me would be the other type of exposure that you as an association or entity would have.
Okay. Thank you. A follow-up to that. Obviously, there's a sensitivity, a price or a cost sensitivity to the insurance, and where the levers are is something that would require, I think, a more detailed study than we would ever want to do in this, especially without preparation. Can you tell us, when was the last time the community took a serious deep dive into our coverages vis-a-vis premiums?
That's an annual event that we go through, actually, John. So we meet with them 3 or 4 months. We meet with the administrative group, I think you called it. We meet with them 3 or 4 months in advance. We give them a state of the insurance marketplace about what's going on, what we see happening in the marketplace, types of claims that are happening, what's happening from a rate perspective. We share that knowledge with them. We then go out to the marketplace. We talk to the different carriers, find out best price and coverage to them, and then we come back and present alternatives to the administrative group, yes.
Okay. Then my last question for this round, I promise, is actually to our chairman. Is this a topic that the committee ought to do a further research in internally to kind of review and get more the specifics? My sense is that I know I don't know a lot about this topic, and I doubt seriously that every member of this committee is very well versed in the, if you will, the levers and the cost benefits of what we do. Is that something that ought to be considered? And if in your judgment it is, I'll leave it with you to take care of it. And otherwise, I've made my comments, and I don't know that it needs to go much further in my mind.
Yeah, we're still a policy board, and I think we have to keep that in mind. So as far as the determination of the value or the coverage limitations, my sense is that would be left to the staff here. I think what we would look at is the overall value, relative to. I'm kind of stuttering on this, and I openly admit that. I think I'll just say I believe that the determination of limitations is not a BNF function. The amount that we recommend for approval is a BNF function. So I openly admit that I would really want to know more about this. I'm not sure that this is the venue for it, but maybe we're going to have to do something internally just for our own growth and development of an understanding of all of these different policy requirements.
My intention was not to put you on the spot, but just to get it out there in the open. So thank you very much for your
Thank you.
reply.
I will say that, excuse me, I will say that we do, when we go through the renewal process, we look at all of these coverages, and we talk about industry averages, we talk about exposure, where our exposure is, where it isn't. We talk about values, what our risk is. So we do discuss this and consider it, and we've even gotten some information on some of our counterparts, and we feel very good about the insurance premiums that we pay for what we get and the coverages that we do have. I don't want that to go by the wayside, because we really do discuss and analyze these things, and Brown & Brown is a great partner with us in that process. We've been fortunate on claims. There is some claims data in here, so he'll get to it in his presentation. But we've been fortunate on claims recently, and but like everybody else, we've been unfortunate in terms of inflation and the things impacting the industry. But I just wanted to put that out there and make sure everybody understands that.
And I think there is a degree of comfort. We would have expected that you're doing that. And I think when you come back, and although I don't think it would be anything other than just reminding the committee that you've gone through this exercise, there is some intellectual diligence that goes into determining how much the limit should be. And I think that would help give us more comfort when the whole issue with casualty insurance is presented. So we do have more questions. I think Mr. Bagnano, and then I believe Ms. Novello may have a question as well. Frank?
Welcome to you both, and John, I appreciate greatly that all your answers have been clear and easy to understand, and we appreciate that because I'm not sure if there's anybody that's sitting at this table that really has the in-depth knowledge of the insurance business. What I can do pretty well, though, is read, and so let's go down to the blue line there, and I'm looking at two particular coverages. One is the auto liability and physical damage. The other is the liquor liability. The liquor liability, correct me if I'm wrong, is our coverage for if someone is served alcohol connected in some way to the recreation center. It's covering, they go out and wreck. Am I correct?
Correct.
Okay, so I'm looking at those two coverages. We have $1 million limit on each of them. And I'm just going to ask you point blank, do you think, given the ease with which lawyers will sue, are we underinsured? In your opinion?
You actually have $25 million of additional coverage above the million on
Okay.
both of those lines of coverage. So if you were to have an auto accident, one of your vehicles is on the road and hits the school bus and injures, kills a number of people, your coverage would be the 1 million plus the 25, so you could get $26 million for that type of claim. Same example would exist for liquor liability. So somebody gets served alcohol here, goes off premises and causes bodily injury. You would have coverage there for $26 million. And general liability, so that is somebody slips and falls, you provide an unsafe environment, wet floor, they fall, crack their head, something along those lines. You would have $26 million of coverage for that as well.
Got it, understood. Again, I don't know a whole lot about coverage,
Yep.
so appreciate it, thank you.
And then I would just add the last piece on this chart. So you led me into, so I can talk about this page here. The last thing on here is directors and officers and employment practices coverage there. You've got $5 million plus another 10. So there's $15 million in coverage for that. Okay. And so what are the types of claims that would come to the directors and officers and employment practices? It's pretty hard to come up with a claim that someone would sue the board of a private entity for, but clearly it can happen. It could be a municipality may sue you guys for something you did that was in conflict with city code or something like that. If you're a public entity, D&O coverage, you can kind of get at mismanagement of the company. That's what it really is there to protect. The majority of that $35,000 premium item for D&O and employment practices is for employment practices. That's wrongful termination, harassment, or discrimination. Those main types of coverage there. And so that line of coverage, you've got the $15 million in coverage there.
Christine, did you have a question?
No, all my questions have been answered.
Okay,
Thanks.
thank you.
I'll wait for the rest of the.
Okay, one quick question, Gary.
Have we had any of those kinds of claims? Discrimination, the things that you rattled through?
None that I remember off the top of my head in the last 5 years. Insurance, we usually use the past as an indication of the future. We usually look 5 to 6 years back is about the time frame we look back. Sometimes we may look further, but I don't recall anything in the last 5 to 6 years.
Thank you, and we really appreciate your patience with us. So if you go ahead and proceed, we're going to.
No, I would rather take your questions. I mean,
Well, we don't want to be here all morning.
Well, I'll take your questions. So we touched real quick on all of those coverages there. except for the property. And we briefly talked about that as we've got that structured. So we took all your properties, $57 million in value. And then you can kind of see we've got different deductibles on there, on the different policies there and stuff, okay? This page is some miscellaneous lines of coverage. People may ask, do I need to buy these lines of coverage? And you don't have to buy anything, quite honestly. You know, you may have to buy auto insurance to be in compliance with state auto requirements. But you may not have to buy property insurance. But if you have a loan, a bank may make you buy the property insurance. And as prudent risk management practices, you may choose to say, I want to self-insure something, or I want to buy insurance and transfer it to another entity. So for instance, here we've got a small little policy that's covering what we call inland marine. So you have a bunch of equipment that is maintaining the properties, that's mobile, it's moving about from here to there, golf carts, other equipment like that. There's a small little policy to cover that. You guys have a cyber policy. You guys have a website. People go to there. You may store some secure information on it. So there could be a need for you guys to want to purchase that. Pollution liability. On the golf courses, you guys are applying different chemicals and stuff to the ground. Somebody could claim that they got injured from the pollutant, and or in the future, the pollutant drains into the water system. And so you guys could get brought in for exposing others to that pollutant. You buy a fiduciary and a crime policy. There is, I assume, maybe some of the board members are fiduciaries of various pension or 401k plans, and or the administrative staff is acting as fiduciaries or administrators of the plan. We need to buy coverage for them. You have a crime policy, and so that is people were to steal monies, employee dishonesty. And then there is a need in a few situations where we have a fiduciary bond for you guys. So those are the lines of coverage that we purchase for you that add up to that $590,000. This page is the smallest piece of the premium. It was the first page where the bulk of the premium is related to it, okay? Any questions on any of these coverages? David?
So on the cyber coverage, I mean, do we have, in essence, what amounts to ransomware coverage?
Correct.
Okay. So, you know, because obviously we just had an incident where we had some issues with our ticket sales, those kind of things that were done online. So what's the 10-hour waiting period?
On the cyber, so if they were to shut the business down, let's say the golf courses couldn't book tee times, the restaurants couldn't take reservations. So think of that as a deductible that they're going to say that I'm not going to pay you for the 0 to first 10 hours where you're down, but after that I'll start paying for the loss of revenue that would happen.
Go ahead and proceed.
We've talked generally about the claim information. You know, for this audience, we tried to come up with simplifying, you know, a lot of pages down to a few short pages here. And so one thing that is important as we think about how the insurance company thinks about your account is how much premium are they collecting compared to the losses that they're collecting. That's a fair one benchmark that they may look at, right? And so we have shown on the top the last 5 years of premiums for the listed lines of coverage. John, the 590 applies to all of the lines. And, you know, I don't show, for instance, the umbrella on here, okay? But these are the main lines of coverage where you guys are seeing claim activity. Ann.
Director Brown.
Do you use a 5-year rolling? So in other words, when you have information for 23, 24, will 18, 19 drop off? Is that what you do?
Each carrier is unique, but roughly it's 5 years, 5 to 7 years for each carrier. You know, Tokyo may look at 5, Travelers may want to see 7. But yes, that's kind of how they look at it.
Okay, thank you.
Christine?
Christine?
Thanks, John. What happened in 2018, 2019? Or I don't know if that's for you, John, or if it's for Cliff, or broadly. You don't have to go into specifics, but we had it looks like we had a couple of really major losses in property or claims in property and general liability. Is it something we can share, or is
I can give
Alright.
you a high level, and Pete can confirm this. I believe we had some damage to trees in the property section, and then in the liability section, I believe that was a trip and fall.
Thank you for answering. Is it
Weather
tough year?
event,
Right,
weather
right.
event for trees. Yeah.
Just goes to show, like one or two seem to be events, right? What can happen in a claim. So thank you very much.
As I recall, I think Todd got $100,000 worth of trees. We bought a whole bunch of trees to replace what was lost.
From a storm.
Okay, you can go ahead.
Yep. And then the last thing that I would we show on here what's called the loss ratio. And the insurance company would look at it. If we looked at the property loss ratio over the last 5 years, we would say that that's a 64%. And underwriters would say that that's borderline not good. Okay? They would really want to see us between 50 to 60% loss ratio, because you have to understand, just as we just talked about in 2018, they could have a year where they're going to pay 2 or 3 times the amount, or 4 or 5 times the amount out in the loss. Conceptually, the carrier could pay out $26 million in one claim for you guys. So 60% is kind of on the high end. If we looked at those 4 lines of coverage, we're at 32%. So we would argue on your behalf that you guys are performing very reasonably for your type of risk. Okay?
One important aspect of it.
He's with Brown and Brown, yeah. So you can.
Sorry about that. One important thing to note that I would just want to point out in relationship to that is that you guys as carrier partner on that package policy is Philadelphia. So they provide the coverage for the property, the auto, the GL, and the umbrella. So even though your loss ratio isn't the best on the property over the past 5 years, they take the total premium for your guys' entire coverage with them into account. And the longer you're with a carrier partner, the better the relationship is with them over time. So that's one factor to consider in the renewal over time. And you guys have been with Philly for a while, and they really like you guys. So just wanted to mention that.
Thank you. Go ahead.
Any questions on the losses? John, go ahead.
Mr. Chairman, I have one.
Oh, yeah, Mr. Holwald.
Is Philadelphia a 5 or a 7 year review? Our big hit was 5 years ago,
Yeah.
which would imply next year that may drop off and our ratio may look much better. Would that be a fair takeaway?
Assuming nothing happens this year.
Correct.
And so, yes.
So I do have a question that I don't understand. We have multiple insurance companies, and they have multiple criteria. Some are 5 years, some are 7. So I presume that the one that's 7 does their own cost ratio or loss ratio, and the other 10, or whatever it is, will do one. So we'll have 10 or 12 different loss ratios.
For the respective carriers, potentially that's the case because of the number of carriers we work with.
And you
Yes.
get the premium from them, and then you bundle it for us.
Right.
So we're really getting, part of our premiums are going to be based on 7 year, they're going to be multi-year claims experience.
Correct.
Okay.
The
So-
bulk of the premium that you guys spend is with Tokyo, Philadelphia.
So this chart that you have here is basically a conglomeration of all of the policies.
No, just the ones with Philadelphia.
Okay.
Yep,
So there would be others that would show better. Okay. Thank you very much.
yep, yep.
Dr. Miller?
So we have a lot of policies. And maybe this is a question for Cliff and you both. When do those policies go into the effect? Are they tied to our fiscal year? Are they just spread across whatever time frame? I'm kind of going back to, the 5 versus 7. So we have this kind of moving target of when our 5 and 7 year periods start. Is that correct?
Yes, so the chart shows the renewal periods, and I believe April 1st is the main renewal period.
Correct.
But we do have other kind of in and out.
The bulk of the policies renew April 1st.
Yeah.
Okay.
Yeah.
All right, thank you.
You guys want me to speed up?
It's your presentation, okay?
I do this all day, so I can talk about this.
We got another couple hours, so
Yeah.
take your time.
You might be here alone, Cliff.
No, we'll wrap it up here. I want to be respectful of your time. At the last few pages, I just presented some. This is a real high-level executive overview of some of the information that we would have been working with your administrative staff on, that talks about the state of the insurance marketplace, what's going on in our marketplace. I believe information helps you guys make good decisions, right? And so, for instance, on this page right here, we're talking about what are the key trends that are taking place in the property marketplace right now. And you'll see the term increasing deductibles, double-digit rate increases, right? So that means 10% or more on rate increases. And when we looked at your property insurance after the values increased and the rate increases that we took, the rate increase you guys had was 3% or less. Okay, so well below what the rest of the marketplace was experiencing. Now, there is certainly parts that are doing much worse than 10 or 15%. A number of related risks that our company insures are in Florida. They're experiencing maybe 50% rate increases on their property insurance down there because of hurricanes and the like. I have a count in California, they're experiencing like 35% rate increases because of the conditions in the state of California. So that is, some information there on the property, high level, just the rate increases. And then I didn't put it on this sheet, but one other really important item the underwriters care about is what is the values of the properties that you're reporting. Most people will report their properties and keep them the same value for 10 or 15 years. And so the underwriters would feel if it burned down to the ground all those years and they had to replace it with like kind and quality today, that they would end up short. Okay? So that's on the property. Did I see a question, a hand? Someone? Okay. Casualty, this is really picking up 2 or 3 lines of coverage. So general liability, that's the slip and falls that may take place. The rate increases and the pressure there is only a couple of points. Auto, the rate increases for the last 9 years, we have seen 5 to 15% rate increases on the auto insurance every year for the last 9 years. And then workers' comp is viewed as pretty favorable right now. I don't do that line of coverage here for you guys. Why are there pressure on the liability lines? It's due to the adverse verdicts that are being obtained by claimants right now. There's terms out there called nuclear verdicts, social justice juries. There's lots of pressure when claimants get hurt. The value of the claim gets sued, and they're looking to collect huge dollar amounts towards insurance. And so when we talk about the number of claims over $10 million in the industry or over $50 million that get settled, those numbers have increased exponentially in the last 5 years. And very simply, I break it down. The person that got hurt yesterday that collected $2 million, the person that gets hurt today, they're worth $2.1 million because they were better, more special than that person yesterday. And so there's this big trend, and so that's driving the liability pricing up. We just do a small surety for you guys. That's the fiduciary bonds that we do there. Executive liability. So this is that D&O and employment practices coverage that we talked about for you guys. There has been substantial rate pressure on the D&O lines of coverage here for the last few years, and in the last few months, that line of coverage has calmed down a little bit from a pricing perspective. And some of that is, I note in here that there's some decreasing claim trends that are taking place there. There is one, I note down there at the bottom, Silicon Valley Bank, that will have a substantial loss, and that could have a ripple effect in the future on some D&O policies. But keep in mind, your D&O is, all these lines are renewed until April of next year. The cyber policies, if you go back 9 months or so on the cyber, we were seeing rate increases of 60 to 70%. And now the claim trend has dropped off pretty substantially, but we're still seeing upwards of 15% rate increases on our cyber renewals right now. Just as like one interesting note, people would probably argue that the war in Ukraine and Russia has limited the number of cyber claims because the fighters are the hackers, and they've been redeployed. Some of our clients have international exposure. You guys don't, so we just put something in there.
So I have one final question. So we paid $555,000 last year, $591 this year. How much are we going to pay next year?
It's pretty early to say right now. I would say that let's assume you have no claims, right? And again, it's hard for me to project out 12 months, but all things being equal, meaning no claim activity, let's assume your value, we're going to have to increase the property again 5 or 7%. I would say you'll pay another 7 or 10% more next year. All things being equal. It's difficult to say at this point in time. We'll go out next year to talk to a number of different insurance companies, and maybe someone will do it for the same price or less. I have to figure out how I can get it to the lowest price possible with you guys. I get that.
Director Brown?
Yeah, thank you, Chairman Rhodes. How much are we at risk of our premium going up? You just mentioned 7 to 10% if we have no claims and everything. How much are we being impacted by claims that are happening in big catastrophic events?
Everybody is impacted by the claims that are taking place in the entire marketplace. The premise of insurance is the claims of few are paid by many. And that's may not feel right. I do my clients have property in the Midwest and they don't have earthquakes and they get charged because of but that is the premise of insurance. And so the question that I come back with to you guys is, okay, we want to control the premium. We don't want to pay that as much. We don't have to buy it, or I can take bigger deductibles to control my costs. Think of your auto insurance. If my auto pricing is going up, I may take my auto deductible from $1,000 to $5,000. I may not like it, but I don't believe I'm going to have an auto claim, so I'll take the deductible up. And so though there is tools that you guys and my clients have that they can control the price. And one tool is I can choose to take more risk. Now, again, we talk with the administrative staff about this, like what is the savings to take more risk? We talk with them about that and talk about the give and take on what is the fair trade-off. But I'll present those options and you guys will make an informed business decision with that information.
I do. Mr. Bosak?
We have a recently hired loss prevention manager on board, Cliff? Oh, gone? We don't have a loss prevention manager.
He came and went?
I guess so. Last time I saw Kristen, she had one, but I was going to suggest, I'll ask who the point person was that person could work with in your company. But
Yep. Well, if we can work with that person.
well, we'll probably get another one, so.
Would welcome that.
So I would say from a committee perspective, we really do appreciate the two of you coming in here to explain this to us. I don't think that any of us at this table would purport to be experts on insurance. And clearly the questions that we have, probably from your perspective, are considered fairly naive, but from our perspective, they were pretty important. So we appreciate your patience with us. Quite frankly, when I read this, I had to read it about 3 times, and I just had no idea. I am going to ask if there's anyone in the audience before
Dick?
we finish with them.
Dick, I have another question.
Oh, okay. Dr. Miller, yeah.
So you mentioned earlier that you had 28 pages worth of claims there in your hand. And I'm kind of going back to Ann's comment about, well, what happens if we don't have any more claims? And I look at the sheet that has your loss summary, and I only count 7 claims here.
There's details, there's the 28 pages gives me all the detail on the claim activity.
Right,
Yep.
so I guess what I'm trying to get back to, this only represents part of the coverages that we have. In these last 5 years, have we ever had a year where we had 0 claims?
Yeah, for sure.
But, okay, so this just covers the Philadelphia guys, so I was talking about the other carriers, so.
Yeah, I would have to research, but my gut reaction is probably two of the 5 years, I bet you haven't ever had a claim.
Okay, sounds like we got detail coming up.
Yeah, I prepared the loss summary, and that is just a snapshot of the main coverages with Philadelphia. But I ran loss runs for all of your guys' insurance coverage, and there was very infrequent claims. And sometimes a claim happens where you report it to the carrier and essentially put them on notice for something that might occur, and then it's 0 paid essentially.
Okay.
So you might see like, oh, well, we had 5 D&O claims, but once you dig into the details a little bit deeper, you'll say it was 0 paid. You just want to put them on notice. So there's nuance to the claim discussion, and I can make a loss summary as detailed as you want or as just a snapshot like I did. So the nuance of claim
I just wanted to
discussion.
get to the point where a 0 claim year was achievable.
It is.
Okay, all right, thank you.
It absolutely is. But we can have big years too, right? And that's why you buy insurance, quite honestly, is to protect you in the bad year. That's, the year you had 200, 300, almost $300,000 in claims. That's the year why you buy it, quite honestly.
Okay, before we ask for committee comments, I'm going to ask if there's anyone in the audience that has a question for our speakers. No? Okay, so let's go ahead and thank you very much. We appreciate you being here. We appreciate the effort that you've put into this, and actually we appreciate the experience that we've had here.
And I'll just end again with thanking you guys for the time commitment today, and thank you for your continued trust and confidence in working with us, okay? It means a lot to us, and we take the relationship very seriously. So thank you.
Okay, can we start with Mr. Bosak? Dr. Miller? Ann? Any comments, Frank? It's up to you.
I feel that this needs to be said and it needs to go on record. The word shocked comes to mind when I see how easily the issue of pushing the credit card fees onto those who incur them has been deferred, tabled, essentially swept under the rug until someone with the courage to do the right thing for the entire community brings it up again. Instead, we get compared to what other communities are doing about out-of-control costs, as if what others do matters more to us. Are we going to be the leading community, or just playing follow the leader because it's easier to do nothing instead of making the difficult choices? The claim that these fees are built into our dues and golf rates means that even those who don't use credit cards, and there are surely many, are paying for the costs incurred by others. This may hold weight when viewing how many of our activities are subsidized by the whole community. But when it comes to credit card fees, one of the single largest expenses hitting our bottom line, the only people benefiting from using a card are the cardholders themselves. No one in this community should be charged with subsidizing the cashback rewards, mileage credits, or any other credit card affinity program the banks develop when that benefit inures to only one person, the cardholder. The cost, estimated at close to $600,000 in the next fiscal year, should and must be charged to the cardholders. To add further insult to injury, the Golf Committee proposes to add another $1 onto greens fees to cover the cost of the credit card fees. This is completely absurd, given we've been told the fees have already been built into the rates. What's the dollar for then, other than being a knee-jerk reaction so as to be seen as doing something? This issue isn't about my family personally, as it affects every frequent golfer. But to put it in perspective, this $1 will add hundreds of dollars to my family's annual golf outlay. If nothing else, allocating this fee where it belongs has the potential to alleviate some of the need for the proposed dues increase, as well as possibly eliminate the need to increase golf rates at all. Are we simply unwilling to consider the possibility that a dues increase doesn't really need to be as large as what's been proposed? It is time we do the right thing, to be the leaders instead of being the followers, waiting to see if another community takes this action first. Thank you.
Thank you, Frank. Christine?
I don't have anything prepared, but I would like to remind us all that we have 2 budget forums with our fellow members and owners next week. Right. So for those of you who are watching or here, but if you're watching this at home and watching it back, please, this is really important. And I would presume that we're going to come back here in our next meeting, and if there are actions that we decide to take based on your comments, it will come next week. So look forward to seeing you guys and anybody who's watching at those.
Thank you. And now I'd like to ask for comments from anyone in the audience. If not, our next Budget and Finance Committee meeting will be on May the 2nd, 9 a.m. here in the lecture hall. And it is 10:09, and this meeting is adjourned.